What if the United States economy collapsed tomorrow? Not a recession, not a correction, but a full-scale financial implosion. Markets freeze, banks lock up, the dollar crashes. In less than 24 hours, the entire global system begins to unravel, and not slowly. But here's the terrifying part. The fall of the United States wouldn't stop at its borders. In fact, 10 countries around the world would be dragged down almost instantly. Some would suffer financial chaos, others might face political instability, a few could even collapse entirely. Which countries? Why them? And how deep would the damage go? This video is your front row seat to a global domino effect that could change everything. We're not talking theory, we're talking real-world dependencies, economic lifelines, and hidden traps that tie the fate of the world to a single nation, the United States. Right now, over 60% of global foreign exchange reserves are held in US dollars. The United States is the world's largest consumer, importer, and borrower. Countries have shaped their entire economies around America's buying power, investment capital, and military umbrella. That's why a US collapse wouldn't be local, it would be planetary. In the next few minutes, we're going to break down, one by one, the 10 countries most vulnerable if the US economy went down. Some will surprise you, others will confirm your worst fears. But all of them reveal a single truth: no country stands alone anymore. Let's start with a country that's tied to the United States economically, culturally, and geographically: Mexico. If the US economy were to collapse, Mexico might be the first to go down with it. Why? Because nearly 80% of Mexico's exports are sent to the United States. We're talking cars, electronics, fresh produce, textiles, industries that exist because of US demand. Thanks to decades of trade agreements like NAFTA and the USMCA, Mexico became a manufacturing powerhouse, but also dangerously dependent. So picture this: American buyers disappear overnight, orders dry up, factories from Tijuana to Monterrey start shutting down, hundreds of thousands lose their jobs, ports idle, highways go silent. But the ripple goes deeper. Mexico received over $63 billion in remittances in 2023. Money sent from Mexicans working in the US. That's more than the country earns from oil. If American wages fall, those payments stop. That's entire communities, especially in rural and southern Mexico, left without their main source of income. Then comes the peso. In a US-led crash, emerging market currencies usually tank. Mexico's peso would nosedive, imported goods from gasoline to grain would suddenly cost more, inflation would skyrocket, the poor would be hit hardest. Now add political pressure, rising unemployment, crumbling safety nets, crime rates surge, cartels expand their grip, social unrest, almost guaranteed. Mexico isn't just America's neighbor, it's America's economic shadow. And when the US stops moving, Mexico loses its footing completely. In the event of a US economic collapse, Mexico wouldn't have months to react, it would have days. Now let's talk about the world's second largest economy, China. On the surface, it might seem like China could weather a US collapse. After all, it's a manufacturing giant, a rising superpower, and the backbone of global supply chains. But here's the catch. China is more dependent on the US than most people realize. Start with trade. In 2023, China exported over $450 billion worth of goods to the US. That's nearly 17% of its total exports. A sudden drop in US demand would send factories grinding to a halt, especially in electronics, apparel, and consumer goods. Next, look at investment. Many Chinese companies rely on US capital markets for funding. A crash in the US would send investors fleeing, triggering panic in China's already fragile financial sector. Foreign companies might pull out, stock markets could tumble. But the biggest ticking bomb? Debt. China's corporate debt has reached over $30 trillion, and much of it is short-term. If global interest rates spike or liquidity dries up, China's debt bubble could pop. Add to that a struggling real estate sector and a slowing internal economy, and you've got a perfect storm. Then there's the yuan. If confidence in the global economy evaporates, currency volatility would explode. The yuan could weaken, leading to inflation at home and tighter consumer spending. Now picture this: closed factories, job losses in the tens of millions, rising unrest, and a government racing to maintain control. In short, if the US economy collapses, China's growth engine stalls, its financial systems tremble, and its status as an economic superpower is seriously tested, And that's just the beginning of the chain reaction. You might think Canada, wealthy, stable, resource-rich, would be able to weather a US collapse. But Canada is more vulnerable than most people realize. Why? Because it's one of the most deeply intertwined economies with the United States on Earth. Let's start with trade. Over 75% of Canadian exports head south to the US, including oil, lumber, machinery, cars, and more. That's not a trade partnership, it's economic oxygen. If US demand crashes, Canada's export engine grinds to a halt. The impact would ripple fast. Canada's energy sector would take a brutal hit. A US recession would tank oil prices, cutting deep into Alberta's economy. That means layoffs, budget shortfalls, and investment freezes. And with less American buying power, manufacturing in Ontario and Quebec would also shrink. But it doesn't stop there. Canada's real estate market is already overheated. If economic fear spreads north, consumer confidence could collapse, leading to a housing correction or even a crash. Combine that with job losses from the export sectors and you get rising defaults, plummeting home values, and a dangerous feedback loop. And then there's finance. Canadian banks are closely connected to US institutions. A Wall Street meltdown would slam Toronto's financial core, putting pressure on banks, pensions, and investment firms. Yes, Canada has a strong social safety net, but even that has limits. If unemployment spikes and public revenues dry up, the country's famed stability could crack. In short, Canada's fate is tied to the US like a smaller boat tied to a massive ship. If the big one sinks, the little one gets dragged down with it, fast. South Korea is often seen as a tech titan, home to Samsung, Hyundai, and world-class innovation. But behind the shiny electronics and skyscrapers is a fragile reality. South Korea is deeply exposed to the US economy. Let's talk exports. In 2023, South Korea sent over $100 billion in goods to the United States, including smartphones, semiconductors, and automobiles. The US is South Korea's second largest trading partner, and the tech sector alone makes up over 30% of its GDP. So what happens if US consumer demand crashes overnight? Orders vanish. Tech companies slash production. Factories cut shifts. Samsung, LG, Kia, they all feel the blow. Tens of thousands of workers could be laid off in weeks. The biggest blow? Semiconductors. South Korea is the world's leading chip producer, and its biggest clients, Apple, Intel, Amazon, are all American. A US crash would collapse demand for electronics, causing a ripple effect through South Korea's entire supply chain. Chip inventories pile up, prices plummet, revenues tank, but it doesn't stop at tech. South Korea's stock market is heavily exposed to US capital flows. If Wall Street burns, investors will flee Seoul too. The won would weaken, making imports more expensive and sparking inflation. Consumer confidence would erode, spending drops, businesses shrink, and then there's geopolitics. With rising economic insecurity, political tensions in the region could grow. Social unrest isn't out of the question. In a country known for high youth unemployment and staggering household debt, it wouldn't take much to shake the foundation. In short, if the US economy tanks, South Korea's tech miracle could turn into an economic nightmare. And fast. Japan is often viewed as an economic stronghold, technologically advanced, politically stable, and home to one of the world's largest stock markets. But if the US economy goes down, Japan could find itself in serious trouble. First, trade. The US is Japan's largest export destination, buying everything from automobiles and machinery to electronics and chemicals. In 2023, nearly 18% of Japan's exports flowed straight into the American market. A sudden drop in US consumer spending would send Japanese factories into a tailspin. But there's another layer investment. Japan is the largest foreign holder of US debt, owning over $1.1 trillion in US Treasury securities. That means any collapse in US bond markets would directly hammer Japanese financial institutions. Pension funds, banks, and insurers would be hit hard. Then there's Japan's own economy, already walking a tightrope. With an aging population, low birth rate, and stagnant domestic consumption, Japan relies heavily on exports and overseas investments to stay afloat. Now add the yen into the mix. In times of global panic, the yen is seen as a safe haven, which might sound good at first, but a sharp surge in yen value would crush Japanese exporters. Their goods become more expensive overseas, just as global demand dries up. And don't forget Japan's mountain of public debt, over 260% of GDP. If recession fears spread, the government would have little room to stimulate without risking a fiscal crisis. In short, Japan may look stable, but beneath the surface, it's walking on a financial razor's edge. A US economic collapse could knock Japan off balance in a matter of days. Brazil, the largest economy in Latin America, might seem like a safe distance from the fallout of a US collapse. But the reality? Brazil could spiral fast. First, trade. The US is Brazil's second-largest trading partner, just behind China. In 2023, Brazil exported billions in goods, soybeans, iron ore, crude oil, beef, directly to the US. Those exports support millions of jobs from Amazon farms to Sao Paulo factories. If the US economy crashes and demand for raw materials plummets, Brazil's export revenue nosedives. The agricultural and mining sectors take a direct hit. Commodity prices fall, businesses fold, workers are laid off. But there's a bigger issue: external debt and currency risk. Brazil owes hundreds of billions in foreign-denominated debt, much of it in US dollars. If global markets panic and the dollar strengthens, Brazil's debt becomes far more expensive to repay. Add to that investor flight from emerging markets, and the real could collapse, sending inflation through the roof. Brazil has faced this scenario before. In the 1980s and again in the early 2000s, inflation soared past 1,000% during crises. A US-triggered shock could reopen those wounds. Then there's the political dimension. Brazil is already battling social unrest, income inequality, and fragile coalition governments. Add a sudden recession, rising poverty, and a devalued currency. It's a recipe for instability, protests, strikes, even uprisings. And let's not forget, Brazil's economy is tightly linked to both China and the US. If both stumble at the same time, Brazil doesn't just face a crisis, it faces a collapse. In short, Brazil's economic boom is built on shaky ground. A US recession could turn that boom into a bust almost overnight. India has emerged as a tech and service giant, home to booming startups, a global IT workforce, and a young dynamic population. But beneath that energy is a deep reliance on the United States. If the US economy collapses, India's economic engine could stall. The most vulnerable sector? Outsourcing and IT services. Nearly 60% of India's IT revenue comes from American clients. Companies in Bengaluru, Hyderabad, and Pune are plugged into Silicon Valley, providing software, tech support, cloud solutions, and back-end operations for some of the biggest US brands. If the US crashes, those contracts get slashed. Tech budgets shrink. Projects are delayed or canceled. Entire companies may freeze hiring, or worse, lay off workers by the thousands. The ripple effect? Fewer jobs, reduced income, shrinking consumer spending. But that's just the start. India is also one of the world's top recipients of remittances, money sent home from Indians working abroad, many in the United States. In 2023, these inflows crossed $100 billion. If American wages drop, that cash flow disappears. Families depending on those dollars would be pushed into immediate hardship. Now add inflation into the mix. If the rupee weakens due to global financial panic, prices for essentials, fuel, food, medicine, would soar. And with over 230 million people already living in poverty, even a slight shock could lead to widespread social unrest. India's economy is fast-growing but not shock-proof. Infrastructure is stretched, the middle class is vulnerable, and millions survive paycheck to paycheck. A US recession would hit India like a hammer, not just economically but socially and politically. Germany is known for its precision engineering, economic discipline, and export-driven success. But it's also heavily exposed to any disruption in the United States economy, and not just through trade. Let's begin with exports. The United States is Germany's single largest non-EU trading partner, accounting for nearly 9% of total German exports. That includes high-value goods like automobiles, machinery, medical equipment, and chemicals. If American demand collapses, factories in Bavaria and Baden-Württemberg could grind to a halt, supply chains would seize up, thousands of workers, especially in the automotive sector, could find themselves jobless. But the risk goes even deeper. Germany's economy is tightly linked to global finance and investment flows. Many German companies hold US assets or rely on American investors. If Wall Street melts down, Frankfurt's financial center would feel the tremors. The euro could destabilize. Investment would dry up. Now think about industrial production. Germany's famed Mittelstand, its network of small to medium-sized industrial exporters, is highly dependent on global demand and trade financing. A United States recession would choke off both, putting even resilient companies at risk. And here's the political wildcard. Germany has been trying to balance between the United States and China for years. If both economies take a hit, Germany gets caught in the middle, without either partner strong enough to absorb its output. Then there's energy. Germany's recent shift away from Russian gas has made it more reliant on imports from United States firms. If American suppliers falter, energy costs could rise again, stoking inflation and political backlash. In short, Germany's industrial strength makes it globally admired. But that strength is built on international demand and transatlantic stability. If the United States falters, Germany's economic engine could sputter next. Saudi Arabia's economy is built on one foundation: oil. And for decades, that foundation has rested on demand from one key customer, the United States. While China now imports more barrels, the United States remains a critical buyer and global price setter. A collapse in the United States economy would trigger a massive drop in oil consumption worldwide. And when demand sinks, so do prices. That's a direct hit to Saudi Arabia's lifeline. Oil exports account for over 70% of government revenue. Without those petrodollars, public spending would grind to a halt. But here's where it gets even riskier. Saudi Arabia is in the middle of Vision 2030, an ambitious plan to diversify the economy away from oil. The country is investing billions in tourism, infrastructure, and technology. But guess where much of that capital and expertise comes from? The United States. American companies help build megacities like Neom. United States tech firms are deeply involved in Saudi innovation efforts. If American markets crash, those partnerships could dissolve overnight. Projects get shelved, capital dries up, momentum dies. Then there's the petrodollar system, where oil sales are priced in United States dollars. If the dollar weakens or becomes unstable, the very structure of Saudi oil transactions could come under threat, causing ripple effects throughout OPEC and beyond. Domestically, the stakes are even higher. With fewer subsidies, rising unemployment, and stalled reforms, public dissatisfaction could explode. And in a country where political stability is closely tied to economic control, that's a dangerous combination. Saudi Arabia has wealth, it has reserves, but if the United States economy collapses, even the kingdom could face an economic and political reckoning. The Philippines might seem far removed from the heart of the global economy, but if the United States collapses, this island nation could feel the shock faster than you'd expect. Here's why. Remittances. Millions of Filipinos work abroad: nurses, caregivers, seafarers, construction workers, and send money home. In 2023, these remittances totaled over $38 billion, making up nearly 10% of the country's GDP. A significant chunk of that comes from the United States. If the United States economy crashes, many of these workers could lose jobs or see wages cut. That means less money flowing to families back home, families who rely on those dollars for food, housing, and education. Entire communities could be thrown into financial crisis. Next up, business process outsourcing, BPO. The Philippines is a global leader in call centers, tech support, and back-office services, most of it for American companies. In fact, the BPO sector employs over 1.5 million Filipinos and generates billions in revenue. If United States corporations slash their budgets during a recession, guess where they cut first? Outsourcing. That's hundreds of thousands of Filipino workers facing layoffs or salary reductions, just as consumer prices rise and government aid stretches thin. Add to that inflation pressures. If the peso weakens and food and fuel costs rise, lower-income households will suffer most. Social unrest could simmer, especially in urban areas already facing high unemployment and inequality. The Philippines may not dominate global headlines, but its economy is intricately tied to American demand and United States-based incomes. And in the aftermath of a United States collapse, millions of Filipino families could be left in economic freefall. If this video opened your eyes, smash that like button and subscribe. The next recession might be closer than we think. Don't miss what's coming next.